Maybe there's a property that you're sitting on right now with huge capital gains. You've been thinking about selling it for a while, but you're kind of on the fence. Well, if all of a sudden you see an increase in the capital gains tax inclusion rate on the horizon, you might want to sell right now to get in front of that freight train. What is up, YouTube? Matt McKeever here, and in today's video, we're going to talk about everyone's favorite subject matter, taxes. And in particular, we're going to be talking about the capital gains tax for Canadians. So, before I talk about maybe the future of capital gains tax, and I'm guessing that's why you're watching this video, is because, what if the government changes the inclusion rate? Let's first go back and walk through the history of capital gains tax and the inclusion rates that we've had. Because a lot of newer investors don't realize tax law is always changing. So we often act as if we live in this bubble where things are set, and this is just the way it's always been. Not true. And so the reason I've got my laptop up here is because there was no way I was going to be able to memorize this. But if you didn't realize, capital gains tax started being included as of 1972 in Canada. So pre-1972, capital gains tax did not exist. Think about the implications that would have had on real estate investing. But moving past that, then pre-1985, it was always 50% inclusion rate. Then from 1985 to 1988, it was still a 50% inclusion rate. Then in 1988 to 1989, it was a 2/3 inclusion rate. 1990 to 1999, it was a 75% inclusion rate. And then it eventually scaled back down to a 50% inclusion rate in 2001 and 2000 till the present day, 2019. And even in 2020 right now, it's a 50% inclusion rate. But what's really important for us to understand, and I kind of skimmed over, but for a brief period in 2000, it went back to the 66 and 2/3 inclusion rate. But what's really important that we understand is capital gains tax, like any tax, is dynamic, and it essentially exists at the whim of our politicians and policy setters. So right now, today, it's a 50% inclusion rate. What that means is, let's say I've got $200,000 in capital gains. Well, I'm actually going to be taxed at my marginal rate on half of that amount. So in essence, $100,000 of that income is going to be included. It's going to have that inclusion into the my taxable marginal rate. So if I'm in the highest tax bracket, let's call that 50% here in Canada, essentially on a $200,000 capital gain, half of that's going to be taxable, and I'm going to pay half of that in taxes because I've got a 50% tax rate, meaning on $200,000, I'm paying $50,000 in taxes. So that's where things sit today. But what's going to happen in the future? And so there's a lot of speculation right now that we could see a future federal government choose to increase the inclusion rates on capital gains because of, all the crazy COVID stimulus spending that we've seen over the years, and the fact that we've literally, I think, increased on a per capita basis over $10,000 in debt per Canadian just this year. I mean, someone at some point is going to have to pay that bill, right? And there's a very good chance it could be us investors that are reaping the benefits from capital gains. So what could a future capital gains rate, tax rate look like? Well, I suspect that it would be very easy for the government to want to inch back up to the 1990s policy of 75%. But it wouldn't even be completely unexpected to see a 100% inclusion rate. And now, as a real estate investor, we need to take a step back and really understand how that could impact us as investors, as well as just other investors and their choices that they're going to make when it comes to investing. Now, let's take a look at, for example, flipping and how an increase in the capital gains inclusion rate might impact the choices of flippers or real estate investors in general. So right now, as a flipper, you're going to be taxed on 100% of your gain because that's considered the whole business model. Where when you're a buy and hold investor and you have that appreciation capital gains, the assumption is that your primary business model wasn't appreciation, wasn't trying to force appreciation like a flipper does. So because of that, you're only going to be taxed on a capital gains inclusion rate rather than the flipper. So again, a flipper who makes $200,000 profit that's in the highest tax bracket, they're going to pay $100,000 in taxes. Whereas that, if it applies as capital gains right now, you're going to actually pay only $50,000. So there's a massive difference there. And it's really important we understand that and how that might incentivize or disincentivize certain actions or behaviors if the capital gains inclusion rate changes. Specifically, what I would put forward as a potential thesis is if we see the capital gains inclusion rate increase to 75 or 100%, you could see a lot more real estate investors choosing to become flippers. Because all of a sudden now, some of the benefits of being a buy and hold investor and letting appreciation do the work diminishes. Another factor that might come into play for us as real estate investors that we should consider if the government changes the capital gains inclusion rate is maybe less owners are going to choose to be sellers. Right now, the fact that you're not being taxed 100% on your capital gains might incentivize some people to choose to sell properties to then go buy other investments. But if all of a sudden you're looking at a full tax bill on it and you're going to have less of your proceeds to roll over and do another investment because, again, side note here in Canada, we don't have a 1031 exchange as real estate investors. Because of that, you might see a lot of investors choose to be buy and hold for a lot longer. So we've seen a lot of investors in the past few years choose to get into small multifamilies, and they do that for 1 to 5, maybe 10 years, and then they decide to grow or move on to larger investments and they sell off their small portfolio. Well, if the capital gains rate tax changes, you might all of a sudden see people trying to hop immediately into those larger buy and holds. Or alternatively, we might see people with small multifamily portfolios choosing not to sell those properties as frequently because of the perception of being penalized if it increases the inclusion rate to a 75 or 100%. Then finally, the other aspect that we should be acutely aware of as real estate investors, if the capital gains tax inclusion rate does change, vendor take-back mortgages. So while we don't have a 1031 exchange here in Canada, vendor take-back mortgages will actually help you smooth how you include the tax liability when it comes to your capital gains. So you can actually defer parts of your capital gains over the life of the loan up to a maximum of 5 years. We've done videos on this in the past, and you guys can go Google to understand the intricacies of this tax planning tool. But understand, if we do see capital gains tax inclusion rate increase to a 75 or 100%, all of a sudden a lot of sellers might become more incentivized to want to do vendor take-back mortgages. So if you haven't already specialized or learned about vendor take-back mortgages, now might be the time to sharpen your pencils and get good at understanding vendor take-back mortgages, because if we do see a shift in government policy and taxation rates, all of a sudden we need to be ready to pivot as real estate investors immediately. All right, that's enough about Matt McKeever going on and on about capital gains. I hope you guys did enjoy this video. I think it's unlike any other video on the internet when it comes to Canadian capital gains taxes. So let me know, jump in the comment section if you enjoyed this, and would you like to see me dive into deeper, nerdier subjects like things like cash damming or the Smith maneuver or other tax-efficient investment strategies? Because I'm an open book. I'm happy to share. The goal of the YouTube channel is really just to provide you guys value. If you've got any questions about capital gains tax inclusion rates, let me know in the comment section down below. And I would love it if you guys would share this video on social media, because again, I think a lot of real estate investors would benefit from understanding that we might be living in a shifting policy world coming up in regards to capital gains taxes, and I just want to make sure that everyone's planning efficiently and effectively. Maybe there's a property that you're sitting on right now with huge capital gains. You've been thinking about selling it for a while, but you're kind of on the fence. Well, if all of a sudden you see an increase in the capital gains tax inclusion rate on the horizon, you might want to sell right now to get in front of that freight train. Anyways, smash the like button, hit the subscribe button if you're new to my channel. I'll see you in the next video.